worth of Goldman Sachs stock, it is easy for him to objectively believe that if Goldman goes, then the world goes, right? Is that a systems risk or is that crony capitalism? Make your own judgment. Real big misconception, and that is that the banking industry was deregulated. Nothing could be further from the truth. We were not deregulated, we were misregulated. The focus of regulation during this boom was not on credit risk management, it was on Sarbanes-Oxley and the Patriot Act. Now, Sarbanes-Oxley, it's all of you know, is the new accounting system supposed to reduce fraud risk. Well, BB&T and all the banking industry had already had Sarbanes-Oxley back in 1990 with the thrift crisis. So this was a redundant system on a redundant system. The Patriot Act is where we're supposed to catch terrorists. The industry spends $5 billion a year on the Patriot Act. You know how many terrorists we've caught? None. You know how many we're likely to catch? What's the probability of one of our tellers catching a terrorist? Close to zero, I would say. And anybody's dumb enough to get caught by us is getting caught anyway. Anyway, $5 billion. There's also, and this pervades today, there's an irrational belief in mathematical modeling. This actually is an intellectual problem in our university, but it's a big problem because all these people I'd call it almost a religious belief in mathematical modeling. Wachovia, Citigroup, all these large companies that failed use mathematical modeling. We were under intense pressure to use mathematical modeling. Thank goodness we didn't do it because the models all failed. Basel, you may have heard about that. That's an international agreement on how much capital banks should have to have. Fortunately, it didn't get implemented in the U.S., but it got implemented in Europe. And it was very interesting. When the financial crisis started in the U.S. housing market, the Europeans were kind of laughing at us. And then about 6 weeks later, all of a sudden, almost all the large European banks failed. And the reason they failed is they were using this Basel capital formula. They had no capital. So they went out of business or got in trouble in a very fast period of time. Now, mathematical models can obviously be helpful tools, but they have two big problems. One of them they call the tail problem, and that is there's this probability, that's supposed to be a small probability of bad things happening. Well, always these tails are bigger because same thing with these global weather models. They're always wrong, right? It's because the tail is much bigger than people project, because who's going to listen to a model that they don't figure out how to get a small tail in it. Plus, if something's 1% probable, that means give it enough time, it's certain. If you build your house in 100-year floodplains, bad news, you will have a flood. It's going to happen. The second problem with these models is you cannot predict human behavior under stress. So all the models, all the Fed models, remember the Fed did not predict much a recession, much less a recession was this, 100% failure of mathematical model. Huge misdirection of management energy. On Sarbanes-Oxley and the Patriot Act, they threatened to put you in jail. That impacts your behavior significantly. This is something that's really interesting. We were talking to a group this morning. The regulators have significantly tightened bank lending standards beyond our control. It's the worst I've seen in my career. Now, you hear Sheila Bair, who heads the FDIC, saying, well, we want banks to lend. That's a lie. The local examiners, remember, the only way a local examiner can get in trouble is if his bank gets in trouble. He's a lifetime bureaucrat. What are they doing? They're tightening standards across the board. I guarantee you today, BB&T is not making loans that we would like to make. We're putting people out of business that we don't want to put out of business because of the examiners, and it's happening across the whole U.S. economy. We have a grading system from 1, which is wonderful, to 10 that's not so good. Probably if you look at that system, what used to be a 4, the regulators have now made it a 7. And so they've effectively tightened lending standards. Talked a little bit about the SEC. One thing I would hit. Over the years, banks set their loan loss reserves using judgment. It was kind of an art plus a little bit of science. And in good times, banks raised their reserves, because the old saying is you make your bad loans in good times. The SEC made that impossible. They wanted to do mathematical modeling. They did those models based on history, and we'd had a great period of low loan losses and forward projections, and no economists, including the Fed, predicted the problems we had. So banks entered this crisis with much lower loan loss reserves than they typically would have had. A lot of the initial losses in the banking industry, which remember, leveraged down the economy, made it harder for banks to lend, were because we didn't have the reserves we would have had the SEC not imposed those arbitrary rules on the industry. Market corrections are not all bad. The world's a better place to live with Countrywide and Washington Mutual out of business. They were huge misallocators of capital. Our credit standards were too loose and set us up for excessive leverage. We had no savings. All bad things. Overinvestment in housing needed to be corrected. What we didn't need, however, was the magnitude of the errors, which we wouldn't have had without the Federal Reserve and Freddie Mac and Fannie Mae, and then we didn't need the panic that occurred when this process was handled. You may remember when the Bernanke and Paulson announced TARP, the $700 billion, everybody just stopped. First, where did the $700 billion come from? Scared people to death. And then we had a lot of ambiguity. Citigroup got saved, Wachovia failed, Goldman gets saved, Lehman fails. Marketers can't deal with ambiguity. Created a kind of spiral down that fortunately has hit a floor, but kind of created a kind of lack of confidence that still pervades us today. Unnecessary uncertainty in how all of this was handled. TARP 2, I call it TARP 2, kind of the infamous TARP program, which is the capital injection into the banking industry. One, just a side, but it's an interesting side. One of the purposes of TARP nobody talks about was to save General Electric. General Electric, about half their business is in the finance business. They do high-risk finance, and they were financing the commercial paper market, and the commercial paper market had locked up. So one of the clear goals in TARP was to save General Electric. Interesting story on TARP. I was personally adamantly opposed to TARP. I wrote Congress. I tried to get it stopped. I failed. But anyway, I thought it was a really bad thing, and I still think it's a really bad thing to have done. And yet, when TARP passed, we ended up taking TARP money. And people say, why'd you take TARP money? Well, the answer is really interesting, and this has maybe to do with the rule of law of the United States. When TARP passed, we got a call from our regulator, and they said, well, you know, this is the essence of what they said. You know, you said, you guys have had much more capital than we've required. We've had these capital standards for 20 years. But we think in this environment we need new capital standards. Now, we don't know what these new capital standards are going to be, but we're confident under these new capital standards that we don't know what they're going to be. You don't have enough capital. And if you don't take the TARP money, we're going to send in a team to make sure that you don't have enough capital. It's the message. Very interesting experience. And we said, okay, we'll take the TARP money. Why would they do that? Bernanke was a student of the Depression. He's an academic, and this is one of his problems, because he thought it was 1930. Whatever it was 1930. Anyway, he's a student of the Depression, and in the Depression, Roosevelt tried to save individual financial institutions, but as soon as he tried to save one, the market jumped on him. So Bernanke says, look, I got to get all the $100 billion financial institutions to participate in this, and we'll sell it as making money available to banks to lend instead of bailing out 3 large financial institutions that were getting ready to fail. So by getting everybody to participate, he obscured what they were really trying to do was bail out 3 large financial institutions. TARP was a bad deal for healthy banks. We didn't need the capital. We had to pay a very high interest rate. They had options on it. It probably cost BB&T $150 million to participate in TARP, money we did not need. We didn't have anybody to lend it to at that time anyway. We didn't need the money. So it was a rip-off of the healthy financial institutions. Now, was TARP necessary? Yes and no. It absolutely was not necessary if they'd handled the process right. By the time they'd announced $700 billion and created a mess, they had to do something, but it was certainly not necessary if handled properly. One of the interesting issues, though, is the long-term consequences, I think, are severe. When you reward bad behavior, you get bad behavior in the future. In my career, Citigroup has failed 3 times. Every time they've been bailed out, and every time they've gotten bigger and worse. A zebra doesn't change its stripes. Same thing will happen again. They've also created an oligopoly where there are 5 large financial institutions defined as too big to fail, practically speaking, and this bill that's before Congress won't change that, which actually in the long term gives them monopoly power because they have an effective guarantee from the federal government. All the healthy financial institutions were hurt by TARP. It really was a subsidy for the institutions that were having problems. What are the possible cures? Well, short term, the Federal Reserve does need to provide liquidity. That's what it's for. But the worst thing they can continue to do is bail people out. We need to let markets correct when the institutions aren't doing a good job. By the way, they don't disappear. You need to let them fail. One of the worst things they've been doing is shoring up GMAC, which is the automobile finance arm, used to be of General Motors. GMAC helped create the automobile problems because they invented the 7-year 100% car loan. So you can get 100% financing for 7 years, which means after 3 or 4 years when you buy a new car, you owe more on your old car than it's worth, so you can't finance a car. And there was plenty of financing for the automobile business, but it just wouldn't be provided on those kind of terms. One of the interesting things is the assumption that we should raise government spending. And in fact, you should have cut government spending. Anybody in here, when your business gets in trouble, do you increase your spending? If you lose your job, would you increase your spending? It's just not intuitively obvious. The argument for that is a guy named John Maynard Keynes wrote a book called The General Theory. You ought to read this book, and it's amazing. If you read it, you'll find out and say, wow, I sure don't want to do that. One of his arguments in his book is in bad times, pay people to dig holes in the ground, then pay people to fill them back up. Now think about that. Spending money on things that don't need to be done, will that raise your economic standard of living? If you want to incent, cut taxes and give the money to people that know how to use it productively and creatively.